Let's jump right in. Welcome back to The Explainer, everyone. Today, we are breaking down a seriously impressive report from the entertainment world. We're looking at Cinemark's incredibly strong Q1 2026 earnings. So if you're an industry watcher or, honestly, just a focused learner who wants to understand the nuts and bolts of a massive corporate turnaround, you are in the exact right place.
Okay, let's dive into this right off the bat because this number is just wow. 143%. That is the massive year-over-year jump in Cinemark's adjusted EBITDA for the first quarter alone. When you see a profitability leap of that magnitude, especially for a traditional brick-and-mortar theater chain, it literally means something major is clicking on the operational side.
So how'd they pull it off? Well, to figure that out, we're going to unpack 5 key pillars today. Q1 2026 blockbuster financials, driving box office growth, the premium guest experience, strong balance sheet strategy, and finally, the future industry outlook. Section 1, Q1 2026 blockbuster financials, unpacking the massive first quarter turnaround. Now, before we get too far into the weeds, let's just do a quick refresher on that financial jargon I threw out. Adjusted EBITDA. Really, it's just a way to measure core operational profitability. It strips out all the unusual one-time expenses so we can see how the basic business is actually performing. And by clearing out that noise, we can fully appreciate the scale of what Cinemark just did. They actually just posted their strongest first quarter across all revenue categories since the pandemic started. Pretty wild. And this brilliantly illustrates that exact leap. Look at this. Back in Q1 2025, they were sitting at $36.4 million in adjusted EBITDA. Skip ahead to Q1 2026, and bam, that number shoots up to $88.5 million. That right there, that is pure operational leverage at work. They expanded their margin by a whopping 710 basis points. Breaking this down year over year makes it even clearer. Revenue jumped a solid 18.9%, growing from roughly $540 million to over $643 million. And while that top line was growing, they simultaneously took a hatchet to their net loss. Yes, they are still technically operating at a loss, but we're talking about going from a nearly $39 million loss down to just $6.4 million. So that revenue growth is absolutely translating into a much healthier bottom line. Now, since Cinemark is a massive global operator, they're in 14 different countries, you'll see them talk a lot about constant currency. Basically, this is just a tool to measure results without letting fluctuating exchange rates muddy the waters. It guarantees that a strong or weak US dollar versus Latin American currencies doesn't distract us from what actually matters, how many tickets and tubs of popcorn they're truly selling. Section 2, driving box office growth, how Cinemark got audiences back to the theaters. So what exactly fueled those massive top-line numbers we just saw? Well, the answer starts right here, with this staggering figure, 39 million. That is the number of individual moviegoers Cinemark entertained globally this quarter. Compare that to the 36.6 million they saw at the same time last year, and you start to get the picture. Getting more feet through the door is the engine that powers this entire machine. But those 39 million people didn't just boost revenue. They actually helped Cinemark grab a much bigger slice of the industry pie. We are looking at a sustained 150 basis point market share gain since the pandemic. And that's not just a regional fluke, it's a trend happening across both the US and Latin America, firmly positioning them as a true leader in post-pandemic recovery. So, where is that $643 million coming from? Well, admissions, the actual ticket sales, are still the biggest chunk at $311.4 million. But look right next to it. Concessions are hot on its heels at $255.2 million. Plus, you can't ignore that other revenue slice at $76.5 million, which includes things like screen advertising. Essentially, the tickets get you in the building, but the real margin, that's built on what you buy once you're inside. Section 3, the premium guest experience, transforming theaters into luxury destinations. Like we just talked about, getting people in the door is really only half the battle. The true game is maximizing what they spend once they sit down. Now, what's really interesting about this is how heavily specific, targeted initiatives drive that revenue. Take their Movie Club loyalty program, it literally generates about 30% of their entire box office revenue now. Or look at the premium large formats like IMAX and XD. They make up only 6% of Cinemark screens, but they pull in 15% of the box office. You add in continuous upgrades like laser projectors and those crazy D-Box motion seats, and you've suddenly created an experience that people are more than happy to pay a premium for. And it turns out this premium strategy directly impacts the snack counter too. Because when people are having a premium, high-end experience, that vibe translates straight to the balance sheet. Thanks to strategic pricing and a very solid 7.5% jump in how much soda and popcorn people are buying, per patron concession spending jumped to $6.54 worldwide. People aren't just going to see a movie anymore, they are genuinely treating themselves. Section 4. Strong balance sheet strategy, navigating debt and controlling costs. To really grasp their underlying financial health, we need to define one more term, the net leverage ratio. In plain English, this just measures how much debt a company holds compared to its earnings. It helps us gauge financial risk. Basically, it tells you how comfortably a company can juggle its debt based on the actual cash it's bringing in.
And when we apply that to Cinemark, it reveals a pretty delicate balancing act. On the positive side, they have a solid $261.7 million in cash and a very healthy 2.6 times net leverage ratio, which is exactly where they want it to be. But let's be real. The hard truths of the theater business are still there. They're still carrying a hefty $1.87 billion in long-term debt. They posted a negative $58.1 million in free cash flow this quarter, and of course that $6.4 million net loss we mentioned earlier. It's an absolute tightrope walk, trying to fuel future growth while still servicing all of that legacy debt.
On top of that, managing this balance sheet means fighting some serious operational headwinds across the globe. Here in the U.S., salaries and wages bumped up 3.5% year over year. Down in Latin America, they're dealing with severe wage inflation, including some government-mandated hikes. And ironically, getting more people into the theaters means higher utility costs to keep those massive buildings comfortable. But, to their credit, management is aggressively fighting back against these costs with incredibly disciplined labor management and tech-driven productivity gains. Section 5. Future Industry Outlook. What to expect in 2026 and beyond. So where does the leadership team see this all heading? CEO Sean Gamble was incredibly optimistic on the earnings call. He said, "We are highly encouraged by positive momentum in core fundamentals that support our industry, including robust studio commitment to theatrical exhibition. And a huge driver of that optimism, the industry is collectively shifting back to a guaranteed 45-day theatrical window before movies go straight to streaming." Gamble sees this as an absolutely crucial step forward for the long-term health of the whole movie-going ecosystem. So the crucial point here is that Cinemark isn't just kicking back after one great quarter. They are aggressively on the hunt. They're actively looking for smart mergers and acquisitions, whether that's snapping up smaller tuck-in theaters or making moves for larger transformative assets. They're also deliberately cranking up their marketing spend because they are seeing fantastic returns on those dollars. And, looking slightly further out, they're already hyping up what looks to be a massive film slate for early 2027. Which brings us to our final thought for today. With the 45-day theatrical window back in play and premium upgrades clearly driving per-patron sales through the roof, the big question is, can Cinemark maintain this blockbuster momentum into 2027? And more importantly, can they finally conquer that lingering debt to achieve sustained profitability? It is one of the most fascinating corporate turnaround stories out there right now, and we'll for sure be keeping a close eye on the box office to see how it plays out. Thank you so much for joining me on today's Explainer. Keep learning, and I'll catch you in the next one.